The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, welcome to this webinar today on the new crowdsource funding. So we'll just get organised. I'm just waiting for a few more people to register. Crowdsource funding for private companies presents opportunities to create new income streams. I think it's a wonderful time to be a small medium enterprise operator, but also to be an accountant to take advantage of these new opportunities. So what's needed is accountancy firms who are committed to being involved in crowdsource funding. It's brand new. No accountancy business has got an historical advantage in this market. And the big news, of course, that's been there since the 12th of September is that there's no need to convert to an unlisted public company any longer. In fact, the whole concept of converting to an unlisted public company ceases 28 days after the Royal Assent was signed. So sometime around mid-October, there'll be no one else converting to an unlisted public company to raise capital under crowdsource funding. So now's your opportunity to get started. Don't miss this great service diversification, because that's what it is. And we're going to talk to you today about the opportunities that I believe are all around accountancy businesses all over Australia. And if you don't react, someone else probably will, because your clients will be, in the main, the targeted group for this legislation, and they will be keen to raise capital, or some of them will. It's targeted at small, medium enterprises and inventors. Not all inventors are going to be able to utilise the early stage innovation company capital raising opportunities. Why? Well, their expenditure may have been over $1 million last financial year, and their income may have been over $200,000. That's the case. They're not eligible under early stage innovation company, but they are potentially very eligible under crowdsource funding. So they're the two main groups that this legislation is targeted at. Now, who are these people the traditional clients of? I believe that they're the traditional clients of the bulk of people who are watching this webinar today, or who utilize the materials that ESS BIZTOOLS produces. Small to medium-sized accountancy firms all over Australia. That's who the traditional market are the clients of. These people are your natural clients. Please don't encourage them to go elsewhere because your accountancy business is preoccupied with preparing income tax returns. There's a lot of potential economic benefits for accountancy firms from actively being involved in this space. But you're going to have to offer them a great service. And many of you are probably going to have to convince your clients that you are interested in undertaking more activities than just tax. Because unfortunately, that's what many small, medium enterprises think, that their accountant is only interested in taxation matters. So there's an education process as part of all this. What's this do for you? I think it creates a new income stream. First of all, you need to determine whether the company is a potential crowdsource funding company. So let's have a look at it. I think you should analyze your clients. See which ones pass the legal tests that have to be met. And phase 2 is some subjective comments and tests to determine if the clients are interested. But in the first instance, I think you're going to have to do a little bit of education, even though there's a lot of small, medium enterprises have a very good understanding of what crowdsource funding equity raising is about. They will need some education and they will need some convincing that your accountancy business is able to assist them. So let's look at the legal test to start with. The group turnover or sales has to be under 25 million per annum. One of the key words there is group. So if your company is part of a group, or your clients have got companies part of a group, you've got to look at the group turnover. And the group asset value also has to be under $25 million. And generally, companies of that size these days are referred to as small proprietary companies. The regulations for crowdsource funding do not mention the number of employees. As I'm sure you're aware, the definition of small proprietary companies covers the sales and asset figures that are on the screen at present, but the number of full-time equivalent employees is stated as being under 50. That is not included in the specific legal tests as outlined in the crowdsource funding legislation. They cannot be listed anywhere in the world on a stock exchange, because if they are, they've got alternative ways of being able to raise capital. They can go to the market via the stock exchange that they're listed on. Let's look at some of the subjective comments as you go about now trying to understand what this opportunity represents to your clients, but also to your firm. And if I may say so, to your team, because this will be interesting, exciting, real accounting work. So the companies can be in any type of industry. So there's some other activities like the early stage innovation companies, which is really narrowing down the type of industries that a business could be from. Crowdsource funding is very wide. It can be a corner store to a professional engineering practice, perhaps even an accounting practice, if you want to test the market. And there's no age specification. Early stage innovation companies, basically the key criteria is under 3 years of age. There is a subsection where a company up to 6 years of age could obtain the status, but crowdsource funding, no age specification. Let's look at some more subjective tests. The type of businesses. I think you need to go through your client list and sit down with your managers or have the team together and say, well, who is an early stage high growth and disruptive companies? I'm sure you'll know who they are because they're normally led by very outgoing people. They have probably got some great ideas. Now, I'm not saying they're all going to be ideal candidates because they're going to have to accept that they've got to work with some other people on their board of directors and other shareholders. And a percentage of the company is going to be owned by other people. And some of your clients will have some difficulty in reconciling all that. Some people, I think, would prefer to have 100% of nothing some days. Whereas this is a wealth creation exercise. But let's go a bit further. Who of your clients want to expand their business? Hopefully that's been recorded whenever any of your team have been talking to them and they've indicated they want to expand their business. Make sure they're on the list to be invited to your seminar. Or are talking about acquiring another business. Or have a real vision for the business. They're excited. They've got a burning desire in their stomach to achieve something. They're probably the ideal candidates to be looking at this activity because they're really going to have to work. Some years ago, I was an advisor in the federal government's COMET program, Commercialising Emerging Technology. And one of my clients in a major provincial city raised $1.1 million. And he subsequently got interviewed by a business magazine. And he indicated in that interview that the night when he realised that the company had accumulated capital raisings of 1.1 million, and he was sitting there signing the share certificates, he was very tempted to give them their money back because he suddenly realised the weight of expectation that was on his shoulders, because most of the shareholders were in fact superannuation funds. And he realised the heavy responsibility that he was taking on, utilising $1.1 million of other people's money. Some of your clients will be subjected to that same pressure. In fact, I'd like to think they all are, so that they do realise that this is a very important phase of their careers that they're going through. And they do have responsibilities to other people. I probably should have asked you that question earlier. But does the company require funding to implement these visions, the visions that are on the screen? I think most companies would need some funding from somewhere if they're going to do that. Let's look at another area that you might not have really thought about when it comes to crowdsource funding, but I think it's a legitimate reason for a company to look to raise some capital. Succession planning. A lot of our clients have not provided for their retirement. If they have a certain age, superannuation really wasn't available until the last 15 years or so. They might not have enough money to retire with dignity. One way to bring some extra capital into the business to allow a payoff to be made would be looking at utilising crowdsource funding as part of a succession planning exercise. Another area that I'd suggest you look at is the balance sheet. How many of your clients that meet the criteria on turnover and assets have got loans and they're not secured on first mortgage on the company's own property, because normally if they are, the company's going pretty good. But if they're loans from other people, the favourite mother-in-law or their favourite uncle or whoever, or they've got finance company loans, they might like the idea of foregoing some equity in their business to get rid of the debt and to get rid of the interest cost by testing the market to raise capital to pay out those loans. They might have loans from family and friends or high credit card debts. So there's another question. Would the directors be interested in raising capital to pay these loans or credit card debts and save interest? So I've given you a few groups of people that you can look at. And whilst I'm going to suggest that you present a seminar, webinar to your clients and invite all of your clients and probably put an article in your local media to see whoever else might be interested in coming along and talking to you, I think within your own clients, you need to also be going through and preparing your own list and then picking up the telephone and talking to them. and finding out if they might have some interest. And some of them may not have thought about it at first, especially when it comes to paying out loans or even on succession planning. So let's look at the capital that can be raised. A crowdsourced funding company can raise up to $5 million every 12 months. The qualification on that, of course, is if the market's interested in supporting them. Would the companies that you've listed at this stage, would they be interested in being able to do this? I've already suggested you present a seminar, but that's just summarising what I should have left under then to say to you. But present a seminar to brief those people about the benefits that they could obtain by raising capital under crowdsourced funding. Within our system, we have a checklist for identifying clients for crowdsourced funding, which will assist you to determine we do have an article which we call BAS, Business Advisory Services 5108. And if you want that, I can send that to you, which just lists out the items that you should be looking at. One of the key documents that has to be produced, or in fact the key document, is the crowdsourced funding offer document. And to prepare a crowdsourced funding offer document, I honestly believe the documentation that's on your screen will have to be produced. A business plan, a budget, company valuation, share price determination, cash flow forecasts, and an information memorandum. My estimate of professional fees to do this work, $20,000 to $40,000. It's a fair bit of income when it's put in the context of what benchmarking.com says is the average accounting fee in Australia, which is about $3,800. There's also another very important activity that you could look at supplying to your clients once they've successfully raised the capital, is to supply a virtual chief financial officer service. Every crowdsourced funding company requires 2 directors, and some of them will have more than 2, of course, and I think you should be encouraging that so that they get some experienced directors sitting around their board table. Those companies are going to need prompt, regular, in detail financial accounts and other accounting information submitted to them. The external directors in particular, I think, will be clearly highlighting the type of reports they require to see each month. There will be a great opportunity for accountancy businesses to be able to supply a virtual chief financial officer service. Some of these companies that raise money under crowdsourced funding may employ a full-time accountant, chief financial officer, but many of them won't. A couple of reasons. They might not have enough work to keep a full-time professional occupied all week, and they might not be able to afford it. But they might be able to afford to pay an external accounting firm $25,000, $40,000, $50,000 to undertake that task for them. Part of the work activity, though, also will include making sure your client understands what the crowdsourced funding intermediary's role is. There are 7 of these organisations that have been appointed by ASIC. They are the gatekeepers, so they are ASIC's representatives, but they also have a very commercial role to play. Once they've checked your client's data, they will then be placing that onto their website, and for a period of up to 90 days, it will then be available for potential investors to review it. It's up to the individual companies to appoint the crowdsourced funding intermediary, and most businesses will need assistance from you, their accountants, to appoint these intermediaries. The intermediaries are based in Sydney, where the majority are, Melbourne, Adelaide and Perth. So obviously in many parts of Australia, there is no local intermediary, and negotiations will have to take place with intermediaries who are located in those major cities, which could be a long way from where your client operates. The big change that's occurred in this legislation, these amendments, is that a proprietary company can now be a crowdsourced funding company. So the requirement to have become an unlisted public company no longer applies. But the proprietary company still has a limit of 50 shareholders as a proprietary company. Employee shareholders are not included in the count of shareholders. So if you've got 30 employee shareholders and 40 proprietary company shareholders, the 30 does not take your total to 70 and therefore put you out of line with the requirements to be a proprietary company. You've still only got 40 shares as far as the proprietary company limit is concerned, and you've got 30 employee shareholders who are not included in the count of shareholders. And any crowdsourced funding shareholders that the company has are not included in the proprietary company count also. Not included. So that's a chart that I've prepared to try to illustrate what's happening. This is a company that's a proprietary company that's got some crowdsourced funding shareholding. The ordinary shareholders are the shareholders in the proprietary limited company. So they're counted up to 50. Employee shareholders are not counted, so they can be unlimited in their number. And the crowdsourced funding shareholders could also be quite a large number, and that is classified as unlimited. Let's look at the capital raising. First of all, as I mentioned at the beginning, you can raise capital under Section 708 of the Corporations Act. This particular section's been in the legislation for about 35 years. It was very difficult to raise capital for proprietary companies before this legislation was introduced. What the crowdsourced funding amendment is saying is that a company can still raise capital partly under Section 708 and partly as crowdsourced funding. Just to remind you, Section 708 allows a private company to be able to raise up to $2 million in a 12-month period from no more than 20 investors. Companies need to be aware of the 50 shareholder rule that applies to private companies to make sure that they do not exceed that in doing a Section 708 capital raising. company could also then raise company as a crowdsourced funding company. So let's go through and look at some of the key aspects of the legislation. A crowdsourced funding offer must be made via the platform, in other words, the website of the crowdsourced funding intermediary. Capital cannot be raised in any other way. It's illegal. The prime reason that everything's got to go through the intermediary is that the intermediary has to sign off that for every investor, the specified investment warnings have been issued. The government is paranoid about making sure that retail investors have been properly warned that investing in a crowdsourced funding company is not a guarantee that the investor is going to make money. The intermediary must hold an Australian Financial Services licence, and he must also have an express authority to provide a crowdfunding service. So that's good, isn't it? The only way you can raise capital is to have a crowdsourced funding offer document that the intermediary has signed off on, and all applications and all application money has to be submitted via the intermediary. You can't go on and have a look on the intermediary's website and say, oh, that's all right, I know Bill Brown very good, I'm going to go and give him the check for $10,000. That's not how it works. Now, all offers must be closed within 3 months, but you can have an earlier close date. But I'll be recommending to everyone I'm working with on this that we take the 3-month period, because if your minimum subscription for your client has not been raised in that period, say 3 months, then the intermediary is bound by the law to hand all the money back to the entities, the people who said they were interested in investing. The maximum investment for a retail investor per company is $10,000 in a 12-month period. An investor can invest in as many other companies as he or she sees fit, but their limit in any one company in a 12-month period is $10,000. There is a cooling off period. It's quite a liberal one, 5 business days of making the application before the observation comes into play. The company is not required to appoint an auditor until the company has raised more than $3 million from crowdsourced funding offers or other offers requiring disclosure at any time. So if the company's raised $1 million under a Section 708 capital raising and $2 million out of crowdsourced funding, $3 million has been raised, an auditor needs to be appointed. We've talked about the intermediaries. They have a financial services license and they are ASIC's gatekeepers. The amendments have set out some other obligations. I've mentioned the gatekeeper. The intermediary has to open a communication channel for the period that a particular company's offer is listed so that a potential investor can raise questions, and the intermediary then has to arrange for the directors and officers of the company to be available so that a discussion could be held and an answer given to that particular investor, potential investor that raised the question. There's need to be disclosure on the financial interest, including fees that the intermediary will obtain. Let's look at some of the potential investors that you might like to think about in this exercise. I've defined them into 4 specific assignments. A sophisticated investor is someone who's earning more than $250,000 per annum and has done so for the last 2 years, or that person has more than 2.5 million net worth, excluding their home, but including superannuation. A proactive enabler, and I got this out of one of the intermediaries' websites. Someone aged 45 to 65 years with net assets of $1 million plus. A progressive enabler is probably aged 35 to 55 and net assets slightly under $1 million. We've also got a budding enabler, which we're describing as someone 25 to 40, and they might be interested in investing some money also. So what's the opportunities for accountants? Opportunity to be involved in a high value service for your clients. A new revenue line that is high margin. I've showed you the potential fees, $20,000 to $40,000, plus the potential to earn as much of that as gain as a virtual CFO service for your clients. It's strategic work, it's interesting work, and it's a value add for clients and will increase your loyalty with your clients. So let's look at some of the indicative fees that we believe could apply on this menu of services. We've got advice on the operations, eligibility, the intermediaries, fees $5,000 to $10,000. Preparation of the business plan, $10,000 to $30,000. Preparation of budgets and cash flow forecasts for up to 3 years, $3,000 to $10,000. Company directors, corporate governance mentoring, which is what we're presenting as part of the corporate governance network, $2,000 to $10,000. Preparation of the CSF, crowdsource funding offer document, $5,000 to $20,000. And operating the virtual CFO service, I think could be from a very low $10,000 up to a quite high $125,000. Depending on location, depending on the types of reports that have to be submitted. I thought it would be interesting to have a look at what one of the intermediaries is saying. Enable Funding was Australia's first crowdfunding platform, trading through the company name that they then had, Australian Small Scale Offer Board, ASOB, started in 2007. That company has raised $148 million for 176 companies in the last 11 years. Enable Funding has got 30,330 members, all of whom are potential investors. Let's move on then to the crowdsource funding forecast. These are the forecasts that Enable Funding have supplied on their website. They're saying that in Australia in 2016, this type of funding would have raised $119 million. And there's their forecasts for the next 5 years. 210, 420, 688, 1 billion, 1.5 billion. In summary, crowdsource funding is a great opportunity for some of your clients to go to the next level. It creates new income streams and opportunities for proactive accountants. So why not plan to create a new income stream out of this new market for your accountancy business? As a subscriber to ESS BizTools of either the gold or silver packages, you have access to the product packages. Now, they're not there today, but they will be early next week because we've had to withdraw everything and re-edit it, rewrite it to make sure it complies with the new legislation. And we're presenting this webinar today to give you an advance warning of the interesting work that's just around the corner. Crowdsource funding is a great opportunity for some of your clients to go to the next level. This is not for every client, and there will be some clients that meet the requirements that I summarized earlier who, for their own personal reasons, don't want to go down this path. And that's okay. If you've got half a dozen of these companies wanting to do something, it would be interesting work within your firm, I'm sure. It does create new revenue stream opportunities for proactive accountants. You might remember the Deloitte report of 5 years ago when they were looking at digital disruption. And one of their suggestions of what affected businesses should do, and accountants were one of the affected businesses in the short term of digital disruption, was to create new revenue streams. This is definitely a new revenue stream. The challenge is going to be whether you and your colleagues in your firm rise to the occasion. If you've got any questions on any aspect of the crowdsource funding legislation, the amendments to the legislation, please send me an email or send me a phone call and I will get back to you. And obviously there are our websites. Thank you for your support of ESS BizTools and ESS BizGrants. I should have looked at the questions a little bit earlier. Yes, I've had a question about that BAS form. We will send that out to you. The recording of this webinar will be available in a couple of days' time, and we'll be sending that out to you then. And we will also send you the PowerPoint slides so that if you wish to conduct some further training within your teams, you are able to do so. So thank you very much for your participation in this webinar today. We will be sending you an email next week when the product packages are reinstalled to the ESS BizTools website so that you will then be able to start using or thinking about using. But I think the thing you can start doing straight away is sitting down and identifying the clients that you think might be interested in. I've tried to give you some of the guidelines to identifying clients earlier in this presentation today. Have a wonderful day. Goodbye.